Welcome to Volatility Trading Strategies. So in this video, I'm going to outline the details behind the tactical balance strategy that you found on the website. Now just recall quickly, we have two strategies here. The first is the tactical volatility, and if you haven't had a chance to look at this one, I'll put a video here. It's going to explain everything you need to know about that strategy. But today I'm going to talk about the tactical balanced. So before we do that though, I want to establish a baseline for what I think people could get on their own without paying anybody any management fees or subscription fees. Because the financial industry, not making any judgments, but the majority of the industry, from hedge fund managers to the mutual fund industry, all the regular financial advisors out there, the majority of them do underperform the benchmark indexes. So again, no judgments, but we have to be aware of that after you back out the management fees, they do tend to underperform. So what I want to do first of all is give you a fund that you could potentially invest in that would be virtually free, and the performance has been reasonably well over time. So the benchmark fund that I always use is this blue line here. Now the S&P 500, which is the stock market, it's a fine benchmark and a lot of people use it to compare their results against. But when you're investing on your own, of course, you shouldn't put all of your money in the stock market because it's quite volatile. So here's a variation on that where you would put 50% of your money in stocks, 25% in bonds, and 25% in gold. Now this is virtually free to invest in. It would have cost $30 back here. And you can see the results more or less track the stock market. Actually, because of the diversification, it did better during the financial crisis, and it's also done better recently when we've seen some significant declines here. But this is a good fund. It doesn't really cost any money, and anybody out there would be okay to be investing in this. Now, of course, you're not going to be a multimillionaire investing in this, but it's a pretty good solution for people who are looking to not pay anybody any fees. So this is the fund that I always use to compare my results against. The tactical balance strategy is similar to this in that I'm also holding 50% stocks, 25% bonds, and 25% gold. The only difference is I'm doing it tactically, which means that I'm only holding one of those positions at once. Whereas in this fund, you're holding all three of them at the same time, basically a buy and hold style investment. And the reason that I do that is because each one of these asset classes on their own, especially stocks and gold, have significant periods of underperformance, where if you were holding them for the long term, it would drag down your long-term performance. So we can just look at the S&P 500 over the same time period. You can see for the most part, you would want to be holding the stock market. And this has been true going back many decades. But of course, there are extended periods of time when you wouldn't want to be holding the stock market because it declines significantly, and that's going to drag down your long-term returns. So if we look at gold, it's the same thing. Gold has also performed pretty well over the last 30 or 40 years, but just in the last 4 years, this is 2011 to 2015, this is a 45% decline. So in the grand scheme of things, you do want to be holding gold for some of your portfolio, but you wouldn't want to just buy and hold it or your returns are going to be dragged down. Now, bonds are more consistent, at least they have been, with interest rates so low. Hard to know where bond market is going in the future, but that's why I'm trading a tactical strategy rather than just buy and hold. How I do this is I've isolated a set of indicators that I feel are the most important ones to be tracking the markets with. So they range from the VIX index itself to the VIX futures term structure, the S&P 500 market, and the underlying volatility in the stock market. And when I combine them all together, what it allows me to do is filter out the trades from the strong ones to the weak ones. So in the example of the stock market, whenever the signals are in their upper range, whenever everything is pointing in the right direction, and all of the signals are of a higher strength, we would be holding stocks. And anytime the signals are ambiguous, if they're contradicting one another, maybe volatility is rising, maybe money is flowing in a different direction, when the signals are pointing to some ambiguity, we will just be moving to cash. So of course this doesn't guarantee success in the short run. We do have losing trades. But what it's doing is it's increasing the probability that we're on the right side of the trade because we're only taking the high conviction signals. So we can actually see how that fund has performed over time when you separate the signals out to only 50% of the stock market. This is what that looks like when we apply it to the MDY, which is an ETF that tracks the S&P 500 midcap. Now, this blue line is much more consistent. Because what we're really doing is we're only taking the high conviction trades and we're moving to cash anytime that there's warning signs. So during the financial crisis here, most of the time, the strategy is spent in cash. This is the European debt crisis. And again, it was looking pretty ugly there, and the strategy was picking up those signals and moving to cash. Again, in 2015, this is in August, and then in early this year, 2016, we saw another substantial decline, and the strategy picked that up and would have moved to cash. Now, if this would have fallen off a cliff, that's when you would really notice it, right? You're in cash, and you're not going to be subject to those massive drawdowns that, they do happen, and some of us, I think I'm one of them, is sort of half expecting to happen again in the next couple of years. So that's going to be the advantage of the strategy, is that it's going to pick up those signals when you really don't want to be holding the stock market. Now, we've done two things here. We've both increased the returns and we've reduced the drawdowns and we've smoothed it out. Now, that's not easy to do. Usually when you increase your returns, you're also increasing the volatility. But because we're doing it using a clever filtering of these signals, we're actually able to do both at the same time. Now, of course, we're not actually going to hold cash the other 50% of the time. We have an opportunity to utilize that cash because fortunately, whenever the signals are weak, whenever the stock market is looking like it's becoming more volatile and there's a flow of money into more safe asset classes, we can actually use the same set of signals to move into different asset classes. So the easiest one to look at, of course, is the gold market. Traditionally, the best time to be holding gold would be when there's a general sense of uncertainty in the broad markets. So when we apply this same strategy to the gold market, and we only take the bottom 25% of those signals, the very weakest ones when volatility is elevated and there's a clear flight to safety going on, this is what we end up with. So the returns are very good considering we're only exposing ourselves to 25% of the market, but we're also smoothing out those returns quite dramatically because, as you recall, the gold market from 2011 to 2015, that's a 45% drop. But in our strategy, that same time period, we really weren't subject to those losses because we're really scrutinizing the signals and only trading when there is a flight to the gold market. And all of those other times when it was collapsing as stocks were rising, of course, we're not going to be in those trades because the signals are much stronger at that point, and we would be moving into the stock market. So I think this speaks volumes to the strategy more than anything else, that, of course, everybody's a genius in a bull market. Gold went from the mid 300s in the year 2000 all the way up to 1900. It's really difficult not to make money when it's such a strong bull market. But the real key to long-term success is not giving it all back when things go the other way. So our strategy very successfully navigated the last 4 years, and it didn't cost us in the long run. The last piece of the puzzle, of course, is what we're going to do with that final 25% allocation. So we've been very successful trading stocks and bonds because they're on opposite sides of the spectrum. When the signals are very strong or very weak, it's more obvious to know what to do. So that last 25% allocation, as you've probably guessed, is going to go into the bond market. Now again, what we've achieved here is by only holding 25% of the market, because as it happens, that's the best time to be holding bonds when it's not quite bull market stocks and not quite doomsday gold, this middle range, we're actually able to capture a pretty good chunk of the bond market returns. And again, we're able to smooth out those returns in the long run. So the reason we're trading the IEF instead of, say, the TLT, for example, is because interest rates are quite low, as pretty much as low as they've ever been, and nobody really knows when they're going to start rising. But now would be a very good time for people to be shortening the duration of their bond holdings. So while the TLT has performed much better than this, the IEF is really where you want to be. You want to shorten those durations, you want to increase your coupon rates. Now is probably the time that people should be getting defensive with their bond holdings. So, now that we've got stocks, bonds, and gold, 50, 25, 25, let's take a look at what that does as a portfolio. The VTS Tactical Balance Strategy, as you can see here, has crushed the S&P 500 from a returns perspective, but what we've also done, which is far more important, is reduce those drawdowns. So, having high returns is great, but long-term investing, what it's really all about is risk management. So we've got the higher returns and the increased safety. Here's some statistics you can look at. The annualized returns are about double the S&P with half the drawdowns. But again, what you really want to focus in on is the Sharpe ratio and the Ulcer index. These are risk-adjusted measures of return that are a much better indication than just the annualized returns by itself. So our Sharpe ratio is more than double the S&P, and the Ulcer index more than 6 times. So it's got great returns, but again, it's far more important to reduce those drawdowns. The last thing that I want to talk about really quick, because there might be people out there thinking to themselves, okay, well, if I double my annualized returns investing in the VTS tactical balance strategy, that must mean that I'm going to have double the money when I retire. So I want to show people why this actually isn't true. You may not have seen a retirement fund calculator before. So I've just made a very simple one here with some basic inputs, and we're going to go through an example here really quick. So let's say a person starts with $25,000. Maybe they're 40 years old and they have a little bit saved. They start with $25,000. Annual addition, you're going to save, say, $1,000 a month. A lot of people out there, you can save that $1,000 a month. It's not easy, but you can be consistent and do that. Annualized returns, we're just going to use the S&P 500. 7.6, that's what it's achieved. We're going to go ahead and use that for our example as well. Management fees, if you're just buying the S&P 500, is very, very low. The expense ratio is about 0.09. So we're going to use that. Annual tax rate is 0. I'm going to assume you're using a tax-sheltered account. And as far as wage growth and inflation, we're just going to make them both 2. Now, real wage growth over the last, say, 100 years has been substantially positive. But in the last few years, as people know, it's been slipping, and it's basically 0 these days. So just to be safe, we're going to use 0 for that. Now, this person is 40 years old when they started. Let's say 30 years later. Let's see how much money they have. This might surprise people, but this person is going to have $1.2 million when they retire. So, that goes to show that if you save consistently and you get a reasonable rate of return along the way, pretty much anybody, regardless of what you do for a living, you can retire a millionaire. Now, it takes discipline, of course, but you can do it. Now we'll go through the same example, and we're basically going to use the VTS returns instead. So $25,000, save the same $1,000 a month. Hopefully people can try to do that. 14.8% annualized returns. We're going to use that number. And now management fees, there's going to be a subscription service, of course. There's a fee there. When you first start out, the fee is a larger percentage of your fund, and then as you go, it becomes a smaller and smaller percent. If you get over $1 million, it's basically not a percent at all. Very, very tiny percentage. So overall, we're going to just say 1%. Actually, let's just say 1.25. Let's just be very, very conservative here. And again, we're going to use 2% for both of those, real wage growth. Now let's see if this person, remember the first person has 1.2 million, which is great. Let's see how this person number 2, after 30 years has. Do they have 2.4? Actually, this person has 4.4 million. Now, they didn't just double their returns, they more than tripled it, 3.5 times their returns. Now, why did this happen? It's because of, as we've all heard, compound interest. This is the way geometric returns compound on one another. If you want to see it in a chart, this is what it looks like. The black line being the S&P at 1.2 million, and the VTS tactical balanced all the way up to 4.4. Now, neither one of these people are starving, of course. That's a lot of money to retire with in both cases. But as you can see, doubling your investment returns is far more than double your retirement fund when you factor it over many years. So the big takeaway here with this retirement example is that pretty much anybody out there can retire a millionaire. You just need those few things working in your favor. So get on the savings schedule. Try to get that 1,000 a month saved if you can. Even 400 or 500 is going to make a big difference in the end. The annualized returns, as you've seen, every 1 or 2 percentage points that you can increase that is going to have a real compounding effect on the final number. So if you can bump it up 5 or 6%, it's going to be huge in the long run. And lastly, you want to have enough time, so you want to start soon. Now, if you are in your 50s or 60s, it's never too late to start saving. It's never too late to start investing wisely. So that's what I can help you with. I can't help you with these first two, the initial deposit, the savings rate. Good luck with that. It's very important. But this is the column that I can help with. And the tactical balance strategy, that's what it's designed to do. This is not something that is meant to be for people who are just playing with a small percentage of their portfolio, just rolling the dice and seeing what happens. This is long-term investing with risk management and safety and preservation of capital as the primary focus here. So this is what I can offer people for building their retirement funds. This is what it's designed to do. So if you found this video interesting and you feel like the tactical balance strategy might be something that's suitable for your long-term goals, then go to the subscribe tab and you'll see that all the strategies offer a free 2-week trial. So you can try this out risk-free. You can cancel at any time. There's the tactical balance strategy in the middle. Again, if you haven't had a chance to check out the tactical volatility video, I encourage you to do that. As you've probably gathered by watching this video, I'm all about risk management. So I do encourage people to try the total portfolio solution, which is a combination of both of the strategies. The increased diversification is going to be better in the long run. So there's a discount for that. It's only $80 a month. And again, you can try it risk-free. You cancel it at any time. If you go over to the How We Trade tab, there's a couple more videos in there, shorter videos, that will go through the whole process. So you can see the email system. And then over here, I execute some live trades during market hours, just to show people that even if you have no trading experience at all, you'll definitely be able to follow along with this strategy. And lastly, if you go to the bottom of any one of these pages, go ahead and sign up for the VTS newsletter. Just put in your name and email address. You're going to get all the blog articles and videos sent to your inbox. Performance reports, so if you're not quite ready to sign up yet, but you want to follow along with the strategy, see where it fits in with your long-term goals, go ahead and sign up for the newsletter and you'll get all of that sent to you. So that's it for the tactical balance strategy. Thanks for watching. Hopefully you found it interesting, and hopefully you join me here at Volatility Trading Strategies really soon. Thank you.